Welcome to the world of finance, where the jargon may seem intimidating, but is actually quite simple once broken down. Today's focus is preferred equity financing, a term that, while it may sound complex, can be easily understood with a bit of explanation. Imagine a company as a multi-layered cake. Each layer represents different types of financing that the company has taken on. The bottommost layer, the foundation, represents debt financing, loans that need to be repaid. The middle layer represents common equity, which is the ownership of the company divided among the shareholders. The top layer, the icing on the cake, represents preferred equity financing. So what exactly is this icing on the cake? Preferred equity financing is a type of investment where investors give money to a company in exchange for a more significant claim on the company's assets and earnings than common shareholders. These preferred shareholders are like VIP guests at the company's party. They have special privileges, like getting their dividends before the common shareholders and having a higher claim on assets if the company goes bankrupt. But why would a company choose preferred equity financing? It's simple. Companies opt for this type of financing when they need to raise capital, but don't want to take on more debt or dilute the ownership of existing common shareholders. This method allows them to bring in the necessary funds without giving away too much control or taking on the burden of debt. In a nutshell, preferred equity. Financing is a win-win situation for both parties involved. The company gets the capital it needs without the drawbacks of debt, and the investors get a higher claim on earnings and assets with a lower risk compared to common shareholders. To recap, preferred equity. Financing is the icing on a company's financial cake. It's an investment that offers special privileges to investors, including priority dividends and a higher claim on assets. Companies opt for this type of financing to raise capital without taking on more debt or diluting common ownership. It's a strategic move, a balancing act that, when done correctly, benefits both the company and the investor. So the next time you hear the term preferred equity financing, remember the multi-layered cake analogy? It's not just a complex term thrown around in the boardroom. It's a calculated, strategic move that could mean the difference between a company's success and failure. And now, you're in the know.